All right, sorry I'm late. I have no excuse. It's my fault. Okay, tonight we're going to talk, I'm going to do chapter 10. Today is September 18. So first quiz next week, September 25th. First half hour, 18:05 to 18:35. If you're late, that's too bad. You only have until 18:35, so you only have until 6:30. Like I said, if you're late, no excuse, just like for me. It's going to be on chapters 2 and 10. Suggested exercises for both the 6th and 7th edition. With the full written out solutions are posted on WebCT in the suggested exercise folder. I'm going to go put the textbook, my copy of the textbook, on reserve at the library because the ordering thing didn't work out. So, but they'll, I'm trying to sort that out now. So, is there anybody here that doesn't have a textbook? Yeah, still a couple, eh? The one thing that I recommend is instead of buying the textbook for like $150 at the bookstore, you just buy a used 6th edition on Amazon for like $40-50. And you're probably even cheaper. The price is right, eh?
Yeah, it is.
Okay. Yeah, I looked up. Sometimes used books on Amazon can get super dirt cheap, but I guess there's still a little bit of demand for this book, even the older edition. Like I said, in this course, doesn't matter if you have the 6th or 7th. And really, the only purpose of the textbook is for the practice problems at the end of the chapter. Like, I don't really make you read. Of course, you're free to do so, but it's not really a requirement of the course that you read the chapters that much. If you want a little extra explanation, it's a good idea, but mostly the course is centered on the slides and the notes and what I write on the Blackboard. So, as far as Go Help a Real Business for Sunbelt, I'm going to take everybody except the last people, because I made my slides. I prepared my course for today. I usually prepare it one day in advance. And so I only had, I think, like 4 or 5 people, and I could take that many people. But then I got emails last night and one like this afternoon. So if the last 2 people, you know who you are, I'll send you an email. You're too late. But the people before that, there's lots of stuff that you can work on. There's another one that's opened up. We're doing a yoga studio deal right now, and so there's two spots for if you want to do some basically learn accounting and finance and how it works in a yoga studio, and apparently it makes a lot of money. So because it's sold for quite a bit of money, so if you're interested in the yoga business, there's 2 spots there. Send me an email, first 2 that I get an email from, first come, first serve. So any other questions before I start? Okay. So tonight I'm going to talk about chapter 10, which the book is divided into groups of chapters. And the group that we're in right now is the capital budgeting group. And what we had was you have 9, 10, and 11 kind of go together. And we did chapter 9 in 2504, which is just basic. What's net present value, what's internal rate of return, that kind of stuff. But once we get into chapter 10 and 11, we get into more realistic cases, more realistic situations of how it's applied in the real world. So we'll talk about a couple of those. So the first in chapter 9, we would basically just give you, this is the cash flow for year 0, this is the cash flow for year 1, blah, 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 and so on. What happens now in chapter 10 is we have to figure out what those cash flows are, as opposed to just being, spoon-fed to you, pre-cooked in a problem. You're given a story and you have to figure out, what are the cash flows for each year and so on. So throughout this course, you're going to hear this, this expression a lot, incremental cash flows. A lot of this course is about taking financial decisions, and so analyzing a situation and then deciding, whether you go ahead or not. And so when you do that, what you want to look at are, what are the cash flows that are going to happen only if I take this decision, and then that won't if I don't. So an example of that would be if I decide to say to open a new location, and so my decision to open that new location or not is going to be based on the extra sales I'm going to have in that spot, the extra expenses I'm going to have in that spot, not what I'm already doing. Because what I'm already doing is going to happen whether or not I open this new location. So that's the concept of incremental cash flows. And we'll see that throughout many of the different chapters. For example, when we do leasing, the incremental cash flows there are, if I buy something, well, I got to pay, a big chunk of cash up front. But then if I lease, then I have the leasing payments. And so in each case, we only look at the cash flows that are incremental. Standalone principle means that the way that you look at, say, a project is in isolation. So what you do is say you have a company that might add like a new plant, or might start a new product. What you look at it is, if you had like a mini company that was just creating that new product, would you start just that company? That's what the standalone principle means. It means that you look at the cash flows are, and then you only consider it like it's own little thing, and you analyze it as such, even though legally it's really operating as some big thing. But you look at it as if it was a single subsidiary company inside a big parent company, and would we want to have that subsidiary or not? That's what the standalone principle is. So ask yourself to know if something is incremental or relevant. Will this cash flow happen only if we accept the project? If it's yes, it should be in your analysis. If it's no, it should not be, because it was going to happen anyway. And say for example, do I want to extend the operating hours of a grocery store? Well, in that case, the rent is irrelevant, because you're going to have to pay the rent whether you're open 3 hours a day, or whether you're open till midnight. So that would be an example of a cash flow that's not incremental to the decision of, do I open for extra hours? If the answer is part of it, then you put the part that occurs or not. Sometimes it's a little bit tricky there. You have to think a little bit. But in the kinds of problems that you're going to see on quizzes and midterm and final, mostly it's the first two. Something either happens or it doesn't. There's not a lot of these, gray area type of cash flows where you got to split. Some of it is incremental and some not. It might show up, but it's pretty rare. Here's an example of relevant cash flows. Jewelry company purchased some land 4 years ago at a cost of $218,000. They spent $45,000 to put the old building down and clear the lot. Now the lot is valued at $237,000, meaning that you could just go and sell it on the open market for $237,000. So if they want to open a new retail store, what do you consider the initial cost of that project? Well, if you're going to sell the lot, right now the decision there would be, do we sell it, do we keep it, or do we build something on it? Selling it or keeping it are really the same thing, right? It's not opening this new retail store. But if you open this new retail store, you're going to have to prepare the lot. I'm guessing, you got to put in some backhoes and flatten the land or something like that. And then it's going to cost you $229,000 to put up the building. So in that case, what is the initial cost of the project? You're going to have to So in that case, whatever you paid for it is, who cares, right? That money's gone. It doesn't make any difference to the decision today. That you spent $45,000 to flatten the old building doesn't make a difference either. If the old building was still there and to build your new store, you have to demolish the building, then it would be incremental. But what you're saying is, in the situation that the lot is in, the 218 and the 45, those are sunk costs, meaning they're gone. It makes no difference whether you go ahead or not. That money is already spent. The lot is valued at 237, so that means that either you'd have to go buy that piece of land, or the alternative is that instead of opening up that store, you just sell that piece of land. So you got to include that in the relevant cost. You got to prepare, and then you got to build. So common types of cash flow, an example just before there, the sunk costs that have been incurred in the past, and there's nothing you can do about a decision today that these costs are going to happen or not. So they're irrelevant to the decision that you're doing right now. Opportunity cost is, well, you could do something else with it. In that case, the opportunity cost is included. In that case, it's instead of building that new store, you could just sell the land. So that's your alternative. So that's why it's included there. Side effects, positive side effects or negative side effects. So positive side effects could be, you do something and then it's going to help something that's already happening. But only if you take that decision. In that case, you would include it. And the negative side effect is, if you do this, something bad's going to happen to something else. So erosion, meaning that, here's an example. You sell computers, and you come up with you're Apple, you sell iPhones, right? You come up with the iPhone 5. Well, once you start selling the iPhone 5, obviously you're not going to sell as many iPhone 4s anymore. So that's going to, the introduction of that new product is going to erode some cash flows that are already happening in your business. In that case, that's relevant to the decision because that's an incremental negative cash flow that's going to happen whether you introduce that new product or not. Other ones are changes in net working capital. We talked about that last week. A pretty regular example is say if you're in retail and you're expanding, you're going to have more cash tied up in your inventory. Say, either you have more square footage in one location or you open another location. You're going to need to put product on the floor. That's going to suck up cash. Another example is, say I'm a business-to-business service of some kind. And then I decide that I'm going to expand into a new geography. And say I'm doing credit sales, like net 30 days. Well, if say my sales double, my accounts receivable are also going to double. So then you'll have, again, more cash tied into net working capital. That's what whenever we look at some of these projects, sometimes it's, we have changes in net working capital. You're a construction company, you bid on a job, you need to buy the materials, and then you build, the house, the bridge, whatever. Well, that's net working capital that is going to be tied up in the project. So that's a cost that you need to look at. Financing costs, so that would be either the interest on your debt or dividends on shares. Inflation, that's not really a cash flow. I really should take that out. The last one, the capital cost allowance. This is something that students often confuse, so let's hope I can explain it more clearly this time. What happens is depreciation is a non-cash item, right? If you do your income statement, you write you have depreciation, it reduces your net income, but it's not cash out of your pocket. Depreciation, specifically the capital cost allowance, is actually a cash inflow in the sense of when you have depreciation, it reduces your taxable income, and so you pay less taxes. So the more depreciation you have, the less taxes you have to pay. So that's called the CCA tax shield, right? It's a cash inflow in the sense of it's reducing the outflow to taxes. Hopefully, I'll explain that to you a couple times more throughout this course. It's a pretty important concept, but it's one of these things that seem backward, like this is something that's a cost, but it's actually creating cash. So you have to think about that, but just think about, by having depreciation, it just reduces your tax payable, and therefore that's a cash inflow. So another example, opportunity cost. What is the most valuable alternative that's given up if you do something? So you purchased a warehouse for $335 6 years ago, and then 4 years ago you made repairs of $60,000. You're paying taxes on the property of $20,000. It's the current net fixed asset on your books of that asset is $268, but you could sell it for $295. That's another reason why I don't like the balance sheet that much as an accounting statement, is because a lot of times it's there's quite a big gap between what's on the balance sheet and what's actually really there. Maybe you bought a building 20 years ago for $500,000, but it's on the corner of say Bank and I don't know, right downtown. Well, it's not worth that much anymore. It's worth a lot more, but the way that it's carried on the balance sheet is the land has a fixed value and the building's been accumulating depreciation. So maybe the net book value of that property is like $300,000, but there's people beating down your doors to give you $1.5 million for it. So whenever we look at these costs and these cash flows, we want the current market value. Who cares what you paid for it 6 years ago? It's completely irrelevant. What's relevant is what could you sell it for today? And in this case, it's the market value of $295. The warehouse is totally paid for and solely owned by your firm. If the company decides to assign this warehouse to a new project, what value should be included in the initial cash flow of the project for this building? Well, it's whatever the alternative, the most valuable alternative, would be to sell it at the market value. So when you do the incremental cash flow analysis for the project and the building's going to be used for that, you use the $295 as what the cash flow for that is. Erosion is if you do something and it erodes. Another word is cannibalize that you've probably heard before. So in this case, and you know that these notes are posted. I put them up on WebCP, so you can you don't have to write everything down because you can just get it online. So you have trees, shrubbery, and flowers. So these are the 3 product lines that you currently have. What you're going to do is introduce flowering shrubs. So I'm guessing the erosion there comes from the fact that you're going to have less square footage on your in your retail space to put those 3 products, or maybe the people that come in, they only have a certain amount of money, so they'll buy less of the previous 3 because there's this new thing that they'll buy more of. So what's going to happen is you were selling 189 of trees before, and after you introduce the new product line, you're going to sell 168,000, meaning that new product's going to erode this line for down by 21,000. The shrubbery is 286,400 before, and after 239,700, meaning that the new product's going to erode 46,700. And then the flowers, before you were selling 62,800, and after you're going to sell 59,900. So what's going to happen is this. You're going to lose 70,600 in your original 3 product lines, but you're going to gain 136,000 from the 4 product line that you're adding. So that's a good decision, right? I make 136 more, but then 70 less, so net, what is it, about 30,000, about 60, 66,200 or so. So that's a good decision. Incrementally, yeah, you're losing sales on the other things, but overall you're going to have more sales because whatever you're losing in the original product lines, it's more than compensated by the incremental cash flow that you're going to get from the new product line. Just a little bit of review, not from too long ago because we did that last week. But okay, one thing I have to warn you about is finance people and accounting people both use the expression pro forma, except that it means completely 2 different things in the 2 disciplines. In accounting, pro forma means when a company publishes their earnings or their balance sheet in some way that's not GAAP or IFRS compliant to illustrate some kind of thing. They publish a certain version of their earnings that makes more sense to understand how the business is doing. In finance, what pro forma means is something looking forward. It's I guess you could just say it's a fancy Latin phrase for a forecast. It really just means forecast. When you say, I have a business plan and these are my pro formas, really all you're saying is this is what my forecast is for the years in my business plan. So computing cash flows, the operating cash flow is the EBIT plus the depreciation. EBIT plus depreciation is known as EBITDA, earnings before interest, taxes, depreciation, amortization. By the way, who here knows the difference between depreciation and amortization? Anybody at all? Nope. No.
Tangible assets.
Correct. And that's something that accountants still get wrong, because at my job at Sunbelt, I look at financial statements that are prepared by CAs all the time, and they still don't understand that. And you still see, amortization for, equipment. A tangible asset is something that's real, like it's a computer, a table, whatever. An intangible asset is like, a patent, a trademark, a goodwill, whatever. When you impair, so amortization is impairment of an intangible asset. Depreciation is impairment of a tangible asset. The other one, which is pretty rare, you don't hear it very often, is depletion, and that's if you have a resource asset. So, I got like that many acres of timber land, or I got a mine that's got proven reserve of that many kilos of gold, and so every year that you pull stuff out of the ground, you're going to deplete whatever that asset is. So amortization for intangible, depreciation for tangible, and depletion for natural resource assets or natural resource rights. The next one is cash flow from assets. Remember that was the picture that I drew for you last week, the big cash flow identity, which is just like you have the balance sheet identity in the balance sheet, you have the cash flow identity on the statement of cash flow, meaning that the internal cash flow of the company, which is the operating cash flow, so selling and paying salaries and rent and all that kind of stuff, minus what you're spending, what the net spend on equipment is, so minus what you bought new equipment, and then plus the cash that you got from selling used equipment, and then minus the changes in net working capital. That's another part that students have a hard time, because it's minus something that's a difference of differences. So people flip the signs, or just make sure you understand how that works. The example being that, like I told you before, if you need more inventory, or if you're growing your sales and you have more accounts receivable, well, that's cash flow that's now, you used to have that cash, now it's tied into either inventory or accounts receivable. So that's the internal part of the cash flow equation. The outside part, remember, is what's going to the creditors and what's going to the stockholders. And obviously the two have to be the same, because you can't have cash that magically appears. If you ever have a company like that, please let me know. I'd be interested. So let's do a pro forma statement. So what a pro forma means, like I said, it's a forecast. So in a way, what you're doing is, this is when you're doing a business plan. What you're drawing up an income statement, which if you execute your business plan perfectly, and that rarely happens, that things work out exactly the way you expected them to be. But if your pro forma income statement, things happen exactly the way your business plan says, then that's going to become what your accounting statement is. In a way, it's a forecast of what your accounting statement's going to be. And you use that to do analysis of things like quantities and selling price and how much money am I going to pay in taxes and so on. So it's just, did I hear a question? Oh no, it must have been just a chair. Excuse me. So less variable costs. Your variable costs are they're also on the same amount of units, but your variable cost is 21 per unit. So your variable cost is going to be 269, 640. Also depreciation. Now, make sure you understand how to do that because it shows up a few times in the course. If you have, you'll see that, that expression a few times. Something is depreciated straight line to zero over so many years. So what it means is, say I have something that's 300,000 depreciated to zero over 3 years. So therefore, each year it depreciates by 100. Well, in this case, something is depreciated, you got 868 depreciated straight line to zero over 7 years. And so the depreciation for a single year is just what the whole thing is divided by 7. So in that case, that's 124.
The half-year rule doesn't play into that?
No. No, there's the half-year rule is something that happens in declining balance. But this is, in that case, I think that's, yeah, I guess that is the tax-based depreciation. Because sometimes you have these things where, you do depreciation one way for GAAP or IFRS, and you do depreciation a different way for tax. But for example, the ones that I know where you do straight line depreciation for tax are leasehold improvements and franchises, and there's no half rule in those. Like if say you spend $50,000, you rent a place on a 5-year lease, and you spend $50,000 to like redo tiles, put up paint, and some cute lights, and so then what you're going to do is straight over the term of the lease, you're going to depreciate you can't use the whole $50,000 as an expense in the first year. If it's a leasehold improvement, you have to take it straight line over the life of the lease. So in that case, say $50,000 over 5 years, you would get $10,000 of leasehold improvement depreciation. Another example is a franchise. The example right now, I'm buying a franchise. I'm paying $25,000, but it's good for 10 years. So I don't get to deduct the whole $25,000 in the first year. What I get to do is deduct $2,500 for each of the 10 years. So the other one is fixed cost. That one is 104,660. That gives you the EBIT. So what are your earnings before you put in interest and taxes? So EBIT is 53,820. And EBIT is quite an important measure in a lot of financial and accounting analysis. For example, a lot of things like banking ratios, things like asset coverage, interest coverage, that kind of stuff is based on EBIT, because it's a measure of earnings that's independent of is your company financed with a lot of debt or a lot of equity, right? It's a measure of earnings that's before you consider what your costs of capital are. The best way to say it is it's a capital structure independent way of saying what the earnings are. Because if you have more debt or less debt, you're going to have more interest or less interest, and therefore that's going to distort what your earnings are. So that's why when you look at a measure of profitability for a company, EBIT is a very big one. So the interest we're paying is $11,050, meaning that our taxable income is $42,770. Pay 35% taxes, so you're going to pay $14,967. And so your net income is going to be $27,803. So that was one of the things that we were asked, what is the net income? But the other one, which is actually way more important than net income, is what is the cash flow? Because a net income is a very poor measure of how you're doing. You can have negative net income and survive as long as you have positive cash flow. But if you have positive net income but no cash flow, you're dead. If you got no cash to pay your suppliers, you won't get more product. You got no cash to pay your employees, they're not coming back tomorrow. So cash is a lot more important than net income in how you see how a company is doing. So first, what is the net income? Second, what is the operating cash flow? Well, operating cash flow is based on EBIT, and it's based on depreciation and taxes. And so remember that you add back depreciation because it's non-cash. So I gave you the example of the chain of fitness gym that we're working on it right now. The guy's barely breaking even on a net income, but it's because he's depreciating so much fitness equipment. In reality, he's got cash coming in. So you have to pay taxes, and taxes are cash that come out of your pocket. So now, you won't see that in the textbook, but another way to think of operating cash flow is as after-tax EBITDA. You won't see that expression, but that's essentially what's happening, right? EBIT plus depreciation, that's your EBITDA. And so EBITDA minus taxes is really the after-tax EBITDA. So that's what really operating cash flow is. And it's one of the most important measures of all the different accounting ratios and net income and what's on your balance sheet and this and that. I mean, that's really, when a company buys another company, that's really what they're buying. They're buying the operating cash flow. They're buying the business. Little bit of review here. Well, it's very similar to what you would have done in Chapter 9, but let's just remind you how you do a net present value project. You know, I don't think I'm going to change classes because, yeah, I have a lot less blackboards, but since I'm able to, you know, use it vertically, it's not such a big issue. And plus, it's really hard to change classes. It's really tough to find a better spot. So whatever they gave us is what we got.
Do we get any formulas for the quiz?
Yeah, always. I just, whatever, yeah, you don't. For the quiz, I put them on the cover sheet, and then for the midterm and the final, I just put it on the last page so that you can rip it out if you want. So instead of putting it on like page 2 or whatever, where you're always flipping, I just put it on at the end. But you need, you know, if you think that you're going to show up into an exam, and because the formulas are there, you're just going to wing it and figure it out as you go, you're going to get slaughtered. Yeah.
We have a class after the exam too? Or
At the midterm?
no, sorry, I'm talking about like after this quiz that we have to do next week.
Yeah, the quiz is just for the first half hour.
Right, the first half hour.
And then there's a class after that. Okay, last example before the break. So this is a pretty standard way that we set up a cash flow worksheet or a spreadsheet. So you have your operating cash flow, you have your net capital spending, and you have your change in net working capital, giving your cash flow from assets. Remember the equation, cash flow from assets is operating cash flow minus net working capital, minus net capital spending minus changes in net working capital. That triangle there, that means change, in case you haven't seen that before. So the operating cash flow is 57 in year 1, 2, and 3. The net capital spending is, you spend $90,000 on whatever. What are you buying? Purchase of equipment. It doesn't say. And then at the end of the project, you're able to sell it used for $17,000. So that's the typical structure that these are set up, right? Obviously, you have no operating cash flow at the project open. This is, I need to buy some equipment and I need to do something else. Then hopefully you have positive operating cash flows. If you have negative operating cash flows, I'm pretty sure that you're going to get a negative net present value. If you have a business that's losing money, stop wasting your time, find something else to do. So you spend 90,000. So that's the typical setup. It's a cash outflow at year 0, and then it's a cash inflow at the end because you sell something used and you get cash for it. The changes in net working capital also, this is the pretty common pattern. So you need to tie up, it says somewhere 15,000 or something. Okay, inventory lowers by 10 and accounts receivable increase by 20 and accounts payable will decrease by 5. So that means if inventory is lowered by 10, you will have 10,000 more of cash. Accounts receivable are increased by 20. That means you will have 20,000 less in cash. So now you're up 10. You're down 10. And then accounts payable will decrease by 5. So now you're down 15. Then you're going to get that 15 back at the end. This is the pretty much the common structure. You have a net working capital that's negative in year 0 and smaller and positive in the closing year of the project. Then you have a net working capital that's the same amount, but it's negative at the open of the project because it goes into the project and it's tied there, and then you get it back when the project is over. And so you sum up your cash flow from asset. And then you just take the net present value of it. Now, I'm going to use this symbol. I'm sorry if you haven't seen it before. It just means sum. So I'm going to say it's the cash flow in year T. T goes from 0 up to 3. And that's divided by the discount rate to the power T. This is just a shorter way. I'm going to write it out this time, but in the future, get used to that symbol because I'm going to be using it quite a bit. This is the same as saying cash flow year 0 plus cash flow year 1 divided by 1 plus R, up to cash flow year 3 divided by 1 plus R to the 3. And instead of writing this whole thing, it's a lot easier to just write it in this compact form. So make sure you understand what that looks like. When you write, a quiz, a midterm, or a final, it doesn't matter to me if you use that or that. If you want to write it out in full, that's fine with me. If you want to write it out in compact, that's also fine with me. It's just when I do stuff on the board, I like to use the compact form. So in the future, I won't be putting that out here. So it's minus 105, and then plus 57 divided by 112. Plus another 57,000 divided by 112 squared, plus 89,000 divided by 112 cubed. And so the total and since it's positive, that means that you should do the project. Okay, so it's 9:13. Let's continue. So, like I said, operating cash flow is an extremely important measure of a company's performance. And it's just convenient that there's actually many different ways to get to it. And last week I showed you 2 of them. I showed you the the basic, which you could, to me, the basic and the top down are kind of the same thing. But so far, you've seen lots of example of the basic way. But you can get to operating cash flow in 1, 2, 3 more ways. So the other one is, but that only works when you don't have interest, is you just take whatever the net income is at the bottom and you add the depreciation. So that would give you the operating cash flow. The top-down approach is you just go through the income statement, but you skip the stuff that's not cash. So you would go through your income statement, but you would not deduct depreciation because that's not cash out of your pocket. So it's just the sales minus what all your costs are, minus what the taxes that you're going to pay. Now, the last one is, it's the most complicated looking, but it's also the most useful. You'll see because it shows up in some of the other problems we're going to do tonight. And what it is you just take whatever the sales minus the costs are, and remember that I showed to you last week that when you multiply something by 1 minus t, you go from pre-tax to after-tax. So that's what you're doing. You're doing sales minus cost. You're converting that to after-tax. And then remember I was talking to you about the CCA tax shield earlier today. So whatever depreciation that you have, it doesn't affect the cash in the sense of it's not, it's not something that's reducing your income, but it does affect the cash because whatever the depreciation expense is, you will have to pay less taxes because of it. And so when you look at the operating cash flow, you look at the project cash flow without the depreciation, convert it to after tax, but then you add back on top of that the tax advantage of having that depreciation deduction, which is just the depreciation times the tax rate. So say you had $10,000 of depreciation in a year, and your tax rate is 30%. Well, that means that that's $3,000 less that you need to pay in income tax. And so that's an inflow in the sense of it's a reduction in an outflow. So an example of the bottom-up approach. Now this one you just gotta, doesn't give it to you, straight out, but you gotta know what it means to have a profit margin of 8.2%. A gross margin is the difference between what your top line sales are minus your variable cost. So whatever that difference, that would be your gross margin percentage when you're halfway down the income statement. The profit margin is basically all the way to the bottom. So, what do you get in net income, in accounting net income, after the taxes and all the different costs? And so, if you have that the sales are not 1.9, it's not telling you there what remember the formula is net income plus depreciation. It's not telling you what the net income is. All it's telling you is that you got 1.9 million in sales and your profit margin is 8.2. So that's your sales. That's your profit margin. And therefore that whole thing is what your net income is. And then you just add back the depreciation. 238, and that gives you see, if you're given that data, the way that it's explained in the way that's given to you in the question, well, you can't use the basic equation because you don't know what the EBIT is. You don't know what the different things are. You don't know what's going on in the middle of the income statement. All you know is what's at the top and what's left at the bottom. So you can't use your EBIT and your depreciation and your taxes. You just have the whole thing. Net working capital 196. That's just useless stuff that you don't need to use. The next one, how to do top down. So Jacob's Jeweler is considering a new product line which is going to produce sales of $450,000 and increase cash expenses by $305,000, meaning that it's going to increase variable costs and fixed costs put together. The depreciation is not included in that because depreciation, remember, is not a cash expense. It's just a figment of the imagination of accountants. So the top down so your sales are 450. The cash costs are 305, and the taxes are 38,000. And so $107. The tax shield approach in this case, the operating cash flow, sales minus the costs, converted to after tax, plus the depreciation times the tax rate. So you're going to get 980 minus 535. And then because the tax rate is 35%, you're going to get to keep 65% of that. Then the depreciation is 1.2 million. It belongs in a 40% CCA class. But also, because it's the first year, you don't get that whole 40. You just get half of it in the first year because of the half-year rule. And then the tax rate is 35. And so the cash flow in that case, operating cash flow, is 373,250. Okay, this is an example in the textbook. Sorry for the people that don't quite have the textbook yet. Like I said, I'm going to go drop off my My textbook at least has a reserve. If you want to get the practice problems out for chapter 2 and 10, you can just go to the library and photocopy the 2 or 3 pages there, or just get them from one of your friends. And of course, that's only for the people that are going to bother studying. So the example here is, how do you use the tax shield approach? In 10.4 in the textbook, there was something about a lawnmower company that was done. They did a certain way. In 10.6, they show you how to do the same analysis using this tax shield approach. So salvage value versus UCC. That last point there is important, that if you're depreciating an asset using declining balance, then really what you want to use is the CCA tax shield, because it's going to account for the future tax effect of having that asset depreciate or decline over time. Now, this is a very ugly formula, but it's going to be given to you for sure when you do a. It shows up in a couple of chapters, and what it is, it's if you buy something, which is the I in that, the investment, the piece of equipment or whatever that you're buying, and then you get rid of it for S, the salvage value, and years later, what is the value today of what you're going to save in taxes? Remember, the CCA is the deduction. The CCA tax shield is what you pay less in taxes. And the present value of the CCA tax shield is basically the tax shield of all the years into the future, but discounted back into the present. It's got this really ugly formula, but in a lot of cases, it's actually easier to use that than to have to calculate say you're doing like a 5-year project or a 7-year or 10-year project. Instead of having to calculate your entire depreciation schedule and I'm going to save that much CCA tax shield in that 1 year, then in that other year, add it to each year of your spreadsheet. It's easier. You just go, you get it, boom, just in one shot. Yeah, it's got lots of variables, but it's just a matter of knowing what all the different letters mean and how to plug in the numbers. D is the CCA rate. So for example, if it's a Class A asset, that would be 20%. If it's a Class 10, it would be 30%. If it's like a Class 45 computer equipment, it'd be 45%, and so on. If it's a building, it would be, if it's if you bought it after 2007, it would be 6%. If you bought it before 2007, it would be 4%. That kind of stuff. That's what the CCA rate is. T is the corporate tax rate. So you've seen that before. K is the discount rate. So that's the interest rate you're using for your present value. SN is N because that's the salvage that happens, let's say, at year 5 or year 3. And then N is however many years you have. So let's do an example. Oh, sorry. Actually, first, the way that I set it up is I'm going to show you a depreciation tax shield for a single year. And then I'm going to do it as, what happens for the whole thing. So if you want to know it for a single year, so the equipment belongs in the 30% CCA class. So you'll get to do half of it in the first year and then 30% after that. When you first buy it, it's worth 600. You pay 642 for it. And so your CCA deduction for the first year is going to be 96,300. And so then at the beginning of the second year, the undepreciated capital cost is going to be 545,700. So that's 642 minus the 96. So now you have something that's 545,700. You get 30% of it in the second year. So your allowed tax depreciation is 163,210. Then,
Is it 210 or 7?
sorry, 710. Then in the third year, the undepreciated capital cost is 381,990. So 30% of that is 114. 597. And so the CCA tax shield in year 3 is going to be what your CCA deduction in year 3 is times the tax rate. So the CCA deduction in year 3 is 114,597, and the tax rate is 34%. And so by the virtue of having a CCA deduction of 114,597, you're going to be saving 38,963 in taxes. Okay, now comes the ugly formula, but that's very useful. How many years? Third year. Sorry? Yeah, K over 2. K over 2 or, 0.5K. Basically, it's that part right there is what adjusts for the half-year rule. If you didn't have a half-year rule, you wouldn't have, it would just be I times D times T divided by D plus K. What that 1 plus a half K divided by 1 plus K does is it adjusts for the half-year rule by shifting the cash flows by half a year. You don't really need to know that, but just so you know, that's where that part of the formula comes from. It has to do with the half-year rule. And the last one, it's because once you sell something, then after that you won't get the CCA deduction going forward, and then you got to discount that back to the present. That's why that divided by 1 plus KN is there. So it's just a matter of, and for that's something that's very important for written problems on the quiz. I did get that question, what the format the quiz is going to be, half multiple choice, half written. And for the written problems, you have to give the formula with the variables, give the formula with the numbers, and then give the answer. So far, that's basically how I've been showing it to you. I just want to make that explicit. And roughly when it comes to part marks for the written part, that's usually I allocate a third, a third, a third. So a third for you putting in the right formula, a third for you, putting in the numbers right, and a third for you knowing how to use a calculator. And a lot of people make that mistake that they just write it out like this, but they don't put the formulas with the variables. That's a third of the marks gone. So, and that's the easiest third to get. Because obviously if you knew how to put in the numbers, you obviously knew what formula you were using. So be explicit. Formula with the variables, formula with the numbers, and the answer. A third, a third, a third. Okay, so the example in the textbook, I'll just go over it in the class anyway, and you can also look at it in the look at all the data in the slides. So you have sales projections for 8 years. So you start selling it at 120, and then you lower your price to 110, and then you have looks like sales go up, then they peak, and then they go back down. So I'm guessing this is a product that's forecasted to last about 8 years, and so these are the revenues that you're going to get. What is the unit price times how many you're going to sell. So that's the first line of your pro forma income statement. The second part is, okay, let's do the, this is if you do it without the tax shield formula. So you got to calculate your entire depreciation schedule, and that gets pretty messy. Because you got to start with what you paid for, what your CCA deduction is, using the half-year rule, and what is your CCA deduction each year, and then carry forward what the UCC is. Then it's quite a hassle to have to calculate that entire table, when all you got to do is just plug in the numbers to that formula, and you get what the present value of all the savings are put together as one single number. So that's your projected income statement. You got the unit price, the unit sales. So what are your revenues? Less the variable costs and fixed costs and the depreciation gives you the EBIT. Less the taxes gives you what the net income is. So that's a projected or pro forma income statement. The projected cash flows are, remember that one of the definitions of operating cash flow is EBIT plus depreciation minus taxes. So you get your EBIT from the previous thing, right? The EBIT there's 75,000, 131,000, 218. So that's what you use there. Then you have what your CCA deduction is, which you had figured out from doing your depreciation schedule. Then you have what your taxes are, which you have from when you did your projected income statement. And so that gives you what your operating cash flow is. And remember that the total cash flow has three components. The operating cash flow, the net working capital, and the capital spending. Well, they just flip those around. It really doesn't matter. But normally you've seen it as operating cash flow, net capital spending, and net working capital. Now, in there, I won't give you something, that complicated, say, in a quiz, midterm, or final, but you'll see some problems sometimes where it says something like, net working capital has to be 10% of sales or whatever, so that if sales are going up, then maybe your inventory is going up and your accounts receivables are going up. But it's not one of those, I tie up a bunch of cash in working capital at the beginning of the project and I get it back at the end. Instead what's happening is over the life of the project, it's going up and down based on your level of sales. And then the net capital spending is pretty simple. You got $800,000 that you spend to start it up, and then you sell it used at the end for $150,000. So those are the changes to net working capital. I'm guessing it's because they're doing a percentage of revenue for net working capital. And so what you do is you just calculate, you know what your revenues are, unit price times quantity. And so I'm guessing that looks like it's 5% or something like that. So it's anyway, it's a certain percentage. And so what you do is, what are your changes in net working capital? Well, 34,000 is the difference between 54 and 20. And so at year one, it goes from 20 to 54, so it goes up by 34. Then at year two, it goes up to 90, so it's gone up by 36 and so on. Then you hit a peak, and then it goes back down after that, and so your changes in working capital start to reverse and become negative. So then your projected cash flows. Don't worry about the cumulative cash flow. That's it's not discounted for the time value of money, so it can be confusing in the sense that it looks like it's a lot more money than it is, because making 300,000 8 years from now, discounted at 15%, that's not worth all that much today. That's only worth 100,000. Cumulative, no. Just ignore that cumulative cash flow line. It doesn't really tell you that much. But you have your operating cash flow, your changes in net working capital, and your capital spending. So you have the cash flow, the total cash flow for each year. And then you just discount it at 15%, gives you your net present value of $4,604. If I was, working for 8 years just to make $4,000, I don't know if I'd really want to do that. Theoretically in the textbook it says, you got to have a net present value bigger than 0, but, I'm going to be, throwing around, $800,000 of capital to just make $4,000. It's not really worth that much. The textbook says, yes, accept the project, but I'll just tell you, common sense is, it's not that great of a project. Just because, look at the internal rate of return is 15.15, but the required return is 15. So, you're just barely making, you're just enough above your cost of capital. And then the last one is the payback is, that's why they had cumulative cash flows, so they could calculate what the payback is. So the project pays back in 4.5 years, because your startup costs are $820. But then by the end of year 5, you've paid back, so you hit the payback halfway between year 4 and year 5. Okay, so you saw all these different tables. You had to do the income statement, you had to do the depreciation schedule, you had to do all these different things. Now look, when you do when you use that tax shield operating cash flow formula, look how easy it is. All you do is your sales minus your cost times 1 minus the tax, the changes in net working capital, and the capital spending. You don't care about depreciation. You just calculate it as a single thing. Well, it has it there, but you could just use the formula also. So it's a lot quicker. It's a lot quicker to do it using that, because what you're doing is instead of having an income statement where you have to add back depreciation and calculate the cash flow and this and that, depreciation just, it just messes up everything. So what you do is you pull it out of the problem separately, you handle it separately, and then you take the present value of all your other cash flows, and then you just add it up that way. Here's the idea in technique between the two approaches. The first approach, what you do is you want to come up with a grand total. So in the original approach, what you do is you sum things up by column, and then you add all of those up. When you do the tax shield way, what you do is you sum things up by row, and then conveniently, the row for tax shield, you can just do it using that formula, and boom, you just add them up. Instead of adding each column and then getting the subtotal that way, what you do is you add up each row, and then you add it up the other way. It's just, you still get to the same point, the same place. It's just a lot quicker to do it that way. And then there's some problems, like I'm going to show you, where that's actually the only way that you can actually get to an answer. All right, so let's get started on this part, and then we'll take a break in about 10-15 minutes. So in 10.7, there's basically, so far we had these kind of generic type of project cash flow analysis. In 10.7, there's 4 specific types of problems that we look at. The first one is a cost-cutting proposal. So you're going to cut costs. You're going to do something, and hopefully it's going to reduce. It's going to be worth doing it because you'll end up making more money. The second one is to replace something. The fourth one is when you're. This is not so much a single go or no go decision. It's more of a I have to do A or I have to do B. So which one do I do? That's the equipment with different lives. If you have like a machine that's going to last 4 years and that's going to cost you that much, but then you have another machine that's going to last you, say, 7 years, it's going to cost you more, but you have to basically calculate the per year cost. So I'll show you that in a bit. And then the bid price, probably the most complicated problem type in this chapter. So I get a couple examples. All right, so let me talk about what's a cost-cutting proposal. The incremental cash flows are, you're going to do something. For example, I don't know, you're going to, I don't remember these. Oh yeah. Say, you're running a restaurant and you got stuff that's rotting. All right, so if you buy a fridge to keep your stuff longer, then you're going to have to pay money for the fridge, but then you're going to save money by not having stuff go rotten on you. There's a couple of other cost-cutting proposals. It could be, for example, we're going to change all the light bulbs to those CFL things. So yeah, we're going to have to pay for the light bulbs, but then after that, we're going to spend less on electricity. So is what we're going to spend to do this cost-cutting project going to cost us less than what the benefits we're going to get? Replacing an asset is similar to cost-cutting proposal, but it's basically you're just looking at, we have a piece of machinery. A good example is printers. The newer printers, especially maybe not like the retail stuff like inkjets or like the retail laser jets, but if you talk about like big commercial print shop printers, there's been a lot of new technology enhancements in the last I don't know 5-10 years that a printer that is like 5 or 7 years old is going to cost you, say, 15 cents in ink per page. But then you can buy a new printer, but then the ink for that one is only, say, 3 cents a page. So do you buy that printer or not? Well, it depends, how much am I using that printer and how much am I going to spend to buy that new printer. If the price that I have to pay to buy that new printer is less than what I'm going to save by having to pay less per page, then that's a good deal. If I'm going to spend like $5,000 on the printer, but I'm only going to save $20 of ink or a toner, then I shouldn't do that. So that's what replacing an asset is. You just buy a new machine. Typically the pattern there is that you buy the new machine, which, yeah, you have to pay, you have a capital cost up front, but then the operating cost is a lot smaller. I guess another example would be, you got a really old car, so you got every now and then you got to fix stuff. So your operating costs, are quite high, and maybe the gas consumption on it is much higher. So is it worth for you, say, spending $20,000 on a new car so that you don't have to spend $200-300 on repairs every month, and at the same time cut your gas bill by half? So that's another example of replacing an asset. You buy a new machine that replaces something that's already operating in your business, and then the purchase cost has to be less than what the benefits you're going to get from having this new thing replace the old one. And typically it has to do with the new thing that you're getting has much lower operating costs. And because of those lower operating, that big reduction in operating cost, it's worth doing the big capital cost up front. The equipment with different lives, that one's a little bit complicated too. Bid price is a little bit more, but so you have, say, a purchase price. So let's say at year 0, 1, 2, 3. So those are cash flows. Well, they're really costs, but I don't want to do my bar chart upside down. So these are the costs of, say, I buy a piece of equipment, for a pile of money, and then it's going to cost me something to run it every year. So here's the idea. What you want to do is figure out what is the net present value of that series of cash flow, and then you want to average it out into a series of equal annuity payments. So what you do is first you take your irregular cash flows and you figure out what the net present value of the whole thing is. Then once you have the net present value, you go back and you flatten it out into a series of equal payments. I'll do an example in a bit. Setting the bid price, that's quite an important topic, because if you're in an industry where, say, you're doing government contracts or something like that, like say like road construction. All right, there's all kinds of things that people bid for. Mostly it's for government stuff. Sometimes very big companies will also set up these these bidding process, but usually it's for government stuff. And so whoever bids the lowest price wins the contract. But here's the winner's curse. Congratulations, you've won the contract. Now you have to do it. In a bidding situation, when you submit a bid, whoever wins that bid, you're legally bound to do it at that price. It's not like you can say, like everybody is saying, is bidding, oh, it's going to, cost, we're going to charge you, $50,000 to do this. And you come in with a bid that says, I'll do it for $20,000. Well, and then once you start doing it, you're like, oh, sorry, it's going to cost you more. Well, that's too bad. You have a binding commitment when you bid for something that you're going to do it at that price. If once you start doing it, it ends up costing you more than you estimated, well, that's you that's losing, not whoever the client is. Usually, like I said, it's the government. So that's the winner's curse. If you win, usually people win because they ended up bidding less to get the work, but then they end up doing the work just to break even or sometimes even to lose money. So just, who cares? Just put in a higher bid and don't win. It's a lot better to not win with a higher bid than to win at a lower bid and then to do the job at a loss or to just break even, right? I mean, why just do something just to break even? It's just a waste of time. So the goal of figuring out a bid price is to determine what is the lowest price you can bid. And what that is, that's a very key point there, is you got to look at your cash flows, and that happens when your net present value is 0. So you figure out, usually a bid price, it's going to be like a, price per unit or whatever like that. So whenever you do the bid price, it's a little bit of a misnomer because you don't actually bid that. You bid, what that tells you is this is the amount that if you bid, you will break even on. So that you should bid more than that. And if you don't get it, who cares? Because, yes, somebody else will get it, but then they'll lose their money, not yours. So I'll do an example in a bit. All right, so let's look here at a cost-cutting proposal. So you have a cafe that wants to buy a new fridge that will reduce food costs by $15,000. So it could be, for example, that either you're going to have less rotting going on, or maybe if you're able to keep stuff cold, instead of having stuff delivered to you every day, you're going to have stuff delivered to you every second day. So maybe you can save money that way. In any case, you buy a fridge for $15,000. And you buy a fridge for $36,000, and then it lowers your food costs by 15. You buy it for 36, and it reduces your food cost by 15 for 3 years. If it's depreciated 0 to 0 using straight line depreciation, means that fridge is costing you $13 a year. Okay, so remember that net income, right, is taxable income times 1 minus the tax rate. So multiplying something by 1 minus t has the effect of converting something from a pre-tax to an after-tax amount. So in this case, what you want, remember that in the end, the only thing that really matters is after-tax cash flow. Because who cares if you're making $1 million if you only have like $100,000 left after you pay your taxes? So every time we do any kind of analysis in this course, we're always concerned about the tax effect because that's the money in our pocket at the end of the day after we've paid our tax bill. So in this case, if that's the net income, then the change in net income is going to be the change in taxable income, and obviously just converting it to after tax. So the change in taxable income for each one of those years is going to be, we're going to make 15,000 more because we're going to reduce our cost by 15,000, and so we're going to make 15,000 more in net income. But that's going to cost us 36,000 for that fridge, and we're going to depreciate it straight line over 3 years. And we want to know what is the net income. So what is that? What does that give us after tax? So we make almost two extra thousand, an extra 2,000 in net income if we buy a fridge. So that's a nice little cost-cutting project, and we should do it. Obviously, if you get a negative number, then you shouldn't. What's the point of say spending? Say you had to pay 100,000 for that fridge, but you're still only saving 15. Then it wouldn't be worth doing it anymore. These cost-cutting proposals all have to do with how much are you paying up front for what gain are you getting in incremental, usually cash flow. The next one, equipment with different lives. That's the equivalent annual cost that I was talking about earlier. So let's just do, I'll just do one, fully out, and then I'll do the second one, because there's two types of equivalent annual cost type of questions. Either it's a single thing and you have to find what the EAC is, or the real reason why you do this is you're faced with the decision of buying machine A or machine B. Now, machine A lasts longer, but it costs more, but maybe it's less per year to operate. Machine B lasts, less time, it's cheaper, but maybe in this case, it costs less to operate. So which one you pick? There's these three variables. If I had, if I just looked at, well, machine A is going to cost me 427,000, but B is only going to cost me 390. Obviously, I would pick B, right? 390 is cheaper than 427. But, yeah, A costs me more, but it lasts longer. So what I want to come up with is, instead of doing, an apples and oranges comparison, I want to come up with two apples so that I can compare them together. That's the measure that you come up with, is what is its equivalent annual cost. So what you do is you take what you pay for the thing, plus what it's cost to run it, and the number of years that it has, and then you come up with what is the per year cost for A. Then you come up with what is the per year cost for B, and then obviously you take the cheapest. Like I said, it doesn't necessarily mean that the one that has the lowest cost is going to be the best one, because maybe the one with lowest cost breaks down twice, only lasts like half the time. So yeah, maybe, I save, 10%, but, in half the time I already got to buy another one. So sometimes you're better to spend a little bit more money if something's going to last longer. But, when you have these cash flows, these series of cash flows over different time scales to compare. How do you do it? Well, you flatten them out into a single amount, which is that EAC, and then you pick the smallest ones. So let me show you how to do this one here. This is okay. So what's happening with machine A? You have a cost of 427, and then for 1, 2, 3, 4 years, the costs are 13,000. So that series of cash flows put together has a net present value of so over its life, the net present value of all the costs of that machine, including what you pay for it at the beginning and what you have to pay each year to operate it, that whole thing is worth 463,376. So now, what you want to do, so you know that those cash flows put together have a present value of 463,376. So now what you want to do is figure out what is the equal payment that's going to have that exact same value, but it doesn't have the big cost up front. So what you're doing is you're flattening out an irregular series of cash flows into what the whole thing is worth. Then you're going back and flattening it out into equal payments. Well, there's 4 of them. So what is that equal payment? Well, what you have is an annuity, right? You have their constant payments, and they're equal to a present value. So, what's the formula for annuity? Present value is payment, and of course those will be given to you. 1 minus 1 plus r minus t over r. Right? That's what the present value is. But we know what the present value is. We want to figure out what the payment is. So the payment's going to be, you just take that fraction and you bring it to that side, meaning that you just flip it around. So in other words, it's the same if I said, you know, A is equal to B times C divided by D. That's the same as B is equal to A times D divided by C, right? Basically, you're bringing the fraction to that side, so it flips around. Running a little bit low on space here. So that's the equivalent annual cost of machine A. Right? That's what those amounts are. They're equal, and the amount is actually 165.6. So that's what an equivalent annual cost is. You flatten out the irregular cash flows into a single cash flow. Now, this question is, you're given two machines. So next you find the I didn't do it because you just do it the exact same way. But then you find out that the EAC for B is 180, 151. And so if the equivalent annual cost of B is 180, 151, but the equivalent annual cost of A is 165, you're better off to pick A because its equivalent annual cost is $14,000 less. So what? That's 14. That's 180 minus 165. So look, A is better, even though it costs 427. It costs more, 427 instead of 390, but it ends up lasting 4 years instead of 3 years. If it lasted longer or less, or based on the operating costs, basically you got to figure out what is that apples to apples number that you can compare, then you pick the cheapest one. Okay, now for the bid price. And here's the reason why I was talking about the tax shield method earlier. Because the only way you can do a bid price question is if you use the tax shield method. You can't do it the other way because you can't figure out what the per year cash flows are all at once. It's easier to, in fact, it's the only way that you can do it, to just figure out what, to do it the tax shield way. Okay, so let's set it up. Let's set up the table. So you have operating cash flow. What is the present value of something? And then you got year 0, year 1, and year 2. So remember that we want to figure out what is our break even. So we want to figure out what is the price that we need to charge per unit to break even as on a financial basis. In other words, to get a net present value of 0. So we don't know the operating cash flow because that's going to depend on how much we charge for the playground. right? If we charge $50,000 for the playground, we'll have a certain amount of cash flow. If we charge, $75,000 for the playground, we'll have a different amount of cash flow. So the reason why bid price is a little bit confusing is because it's not one of these things where you start at the top and you plug in all the numbers and boom, you get to the bottom and you're done. This is something where you start at the bottom and then you work backwards to get what you're looking for. So let's look at the other parts of the cash flow worksheet. You got the net working capital, and you got the the net capital spending, the net working capital, and then the CCA and what the CCA tax shield is. Now, the CCA is not an actual cash flow amount, but the reason why it's there is so that we can calculate it so that we know what the CCA tax shield is. This is an example where you're dealing with a CCA tax shield. So far you've seen CCA tax shield for declining balance. But here we're dealing with a CCA tax shield where we have a straight line depreciation. All right, so let's look at the capital spending. We're going to have in year 0 minus, so basically what we want to do we want to arrive at something that sums up to 0. Right? We don't know what the cash flows are. Well, there's no cash flow in here, but we don't know what the cash flows are. And so we don't know what the present values of the cash flows are. What we're going to do is figure out what are the other cash flows, what are their net present value, and so what is the present value of the cash flow that we need to make the sum of that column equal to 0. So in this case, net working capital, we spend $62,000 to buy tools, I think, equipment, and then it will be depreciated for tax purposes, the straight line to 0, but you will sell it at the end of the project for $39,000. So this is an example where you have one set of capital spending and a different one for tax purposes. So for tax purposes, we're depreciated to 0, but in reality, we'll be able to sell it for $39,000. So the net capital spending is minus 62 to buy at the beginning, and $39,000 to sell it at the end. And so that has a present value. Right? What's the present value of that? Is going to be minus 62,000 plus, we're discounting at 15. So minus 62,000, obviously cash flows that are in year 0, you don't need to adjust them. They're already in today's dollars. And then you have the 39,000. And so the present value of net working capital of the net capital spending is minus 32,510. The net working capital, we're going to put in 12,000, but then we're going to get it out at the end. And so it's this. Yep.
Are we just gonna assume that we get the 12,000 back?
You will need 12,000 in net working capital over the life of the project. Yeah, over the life of the project. So when you're done, you get it back out. That's basically the way that that's set up, where you have the exact same amount that's negative at the start and equal at the end. That's usually the pattern of net working capital. Right? You put in money, and then when you're done, you don't need it anymore. That's what it means in over the life of the project. That's the general, pattern. The net capital spending is a big negative number at the beginning, and then a smaller positive number at the end. And then the net working capital is a negative number at the beginning, and the same number at the end, but positive. That's the pattern that you see. So let's figure out, what is our CCA? It's a little bit tricky there, because remember, I explained that to you last week, that if you sell something and you sell it for more than you were carrying it in undepreciated capital cost, if you sell it for more, you have to redeclare that back as income. If you end up selling it for less, you end up taking it off as a loss. But in this case, our CCA for the first year is going to be 31,000. So that's 62,000 straight line to zero. So 31,000 for the first year, 31,000 for the second year. But the CCA in the second year, normally it would be 31,000, but you ended up selling the thing for 39 instead. And so if you had depreciated something straight line to zero over 2 years, and then not got anything for salvage, then your salvage value would have been equal to your undepreciated capital cost. So there would have been no tax effect. So for example, if I have a computer on my CCA schedule and it's worth $500 and I sell it for $500, nothing happens. If I sell it for $1,000, I have to redeclare $500 of income. But if I say sell it for $400, then I get to put in an extra $100 of loss. So in this case, at the end of year 2, it would have been worth 0, but instead we sold it for 39. So that means that our CCA is going to be a recapture of 8,000. Right? 39, basically 31 minus 39 equals minus 8. So the CCA tax shield, now that's not the actual cash flow. The only reason why we need to know that amount is because once you multiply that amount by the tax rate, then you get what is your reduction in tax payable from having that deduction. So here, the CCA tax shield, if you discount that, no, you don't discount that. All you do is you take 31,000 and you multiply it by 34%. So that's 10,540. And that's minus 2,700. So yeah, I already did that one. The present value of that line is 2,926. And there's no present value here. It's just a utility line so that we can figure out what the next one is. And then the present value of this is 7,109. So that's just 10,540 divided by 115 minus 2,720 divided by 115 squared gives us 7,109. So over the life of that project, having that tax advantage of depreciation saves us $7,100 in taxes. So now we want the number here that's going to make the sum of this equal to 0. Right? In other words, the present value of the operating cash flow plus the present value of net working capital plus the present value of, net capital spending plus the net present value of changes in net working capital plus the present value of the CCA tax shield, that's going to be all equal to 0. So reorganize that equation as and you end up with, well, this is, minus minus. And again, a double negative. And so now I know that if the present value of the operating cash flow is equal to 28,327, then the net present value of the project is going to be equal to 0. So then I want to figure out what are the equal cash flows that are going to give me that present value. That's an annuity. You could also do this as, if you use the calculator, present value is equal to 28,327, I is equal to 15, n is equal to 2, compute payment. That's how you would do it using the calculator, to go from that number to those two. But if you're doing it using the formula, you do it this way. So the present value is 28,327. The rate is 15. And it's over 2 years. Okay, so now I know what my cash flows are. So now I know that if my operating cash flow is 17,400 and 17,400, then the present value of that's going to be 28,000, and then the net present value of the project is going to be equal to 0. So that's where my break-even bid price is. I'm not quite done yet. Now, all I know is what is my operating cash flow. But the question is, what is the unit price per playground? my sales minus my variable costs minus my fixed costs times 1 minus the tax rate is going to be equal to that operating cash flow. Well, what I want to know is I'm going to be doing how many playgrounds? 5 playgrounds. So the sales are going to be 5 times the price. Right? If I do 5 playgrounds and I charge $10,000 per playground, then my sales are going to be $50,000. But right now, what we know this, we know that, we know the tax rate, we know the operating cash flow. We want to figure out what is that unit price. So let's rewrite that equation.
I need the 5 in front of the variable cost.
Yeah, that's 5 because that's normally you would write it as P times Q, right? But we already know what the quantity is. It's 5. So what we want to figure out is what is that price. So we have an equation. We know all of these other variables. We know the cash flow. We know the tax rate. We know the fixed costs. We know the variable costs. All we want to figure out is what is the price. So we rewrite that equation as 5 times the price minus VC minus FC is equal to operating cash flow divided by 1 minus T. And then you just divide by 5 for the whole thing. So what's the operating cash flow? It's 17,424. The tax rate is 34%. The variable costs are 245,000. Let's say that. Variable costs will be 49,000 per playground, and so that's the same as 5 times 49,000. And then the fixed costs will be 18,000. And so finally, you get the, like I told you, the bid price is it's an ugly one. All right, that's it. I'll see you next week. Remember, quiz starts at 6:05 sharp. If you're late, sorry, but don't ask me for extra time because you're late. All right, I'll see you next week.